Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Graham Summers. He's currently President and Chief Market Strategist of Phoenix Capital Research, a global investment research firm located in Washington, D.C. He's a graduate MBA of Duke University with over 15 years experience in business strategy, investment research, global consulting, and business development. Welcome, Graham.
Hi, Richard. It's nice to be here.
Great having you on the show. Today, I would like to focus on your new book, The Everything Bubble, the Endgame for Central Bank Policy. And you've got the book divided into two parts: how we got here, what is to come. So maybe we can base the discussion on that. If you want to give us some insight into how we got here.
Sure, absolutely. So the idea for the book hit me when I saw that central banks, particularly the Federal Reserve in the United States, because I'm based in the U.S., most of my clients are, so my focus tends to be on that financial system. But I noticed that central banks were intentionally creating a bubble in sovereign bonds, which in the U.S. we call them treasuries. And they did this in response to the 2008 crisis. And when I saw this happening, it was cause for severe concern, because in our current way that our financial system is set up, these bonds are actually the bedrock of the financial system. They're the most senior asset class that there is. And if you look at what's happened the last 20 years, we've had this kind of period of serial bubbles. In the late 90s, we had a bubble in technology stocks. They called that the tech bubble. Then when that burst, the Federal Reserve intentionally created a bubble in housing. That was the housing bubble, which led to the great financial crisis of '08. And the significance of that is that housing is a more senior asset class than stocks. And then when the great financial crisis hit in '08, they dealt with that by intentionally creating a bubble in bonds. And so this is what actually gave me the idea for the title of the book, The Everything Bubble. Because if you create a bubble in the interest rate against which all risk assets are measured, you're going to end up creating a bubble in everything. It's like raising the tide of the ocean. Every ship's going to rise as well. So I started writing the book, and essentially what I quickly realized was that in trying to describe these things, most people were probably not going to have a good idea of what I was talking about. And they were also probably going to ask, why are things this way? So I decided to split the book into two parts: how we got here and what's to come. The first half, how we got here, essentially starts with the creation of the Federal Reserve and runs all the way up to about 2016. And I wrote this using very simple, plain language, because a personal pet peeve of mine is that finance is intentionally kept kind of opaque and confusing, because I think it's meant to keep most people ignorant of how the system actually works. So my goal was, I wanted to write at least 100 pages that anybody in the world could read and would instantly be brought up to speed on how did the United States financial system come into being, why was the Fed created, how does the Fed work, how did we get off the gold standard, and eventually leading up to the current era, which is how did we get in this mess where basically every 10 years we're having these massive financial crises, and why is it that central banks are getting away with policies that really are completely insane and which none of us voted for. So I guess that answers your question.
Yeah, that's interesting. And so can you sort of walk us through, in terms of the era of serial bubbles beginning, the Fed crossing the financial Rubicon, leading up to the everything bubble?
Sure, I'd be happy to. The easiest thing to do, by the way, is to just, if you really want to know about these things, is buy the book. It's on Amazon. I think they're running a 10% discount. So if this is stuff you're interested in, by all means, check the book out. But kind of the bullet point way I'd run through this would be, when the U.S. completely severed from the gold standard in 1971, it did two things. Number one is it opened the door to endless money printing. Because up until that point, if the Fed chose to print a ton of currency, central banks and foreign governments could still convert their dollars into gold if they wanted to via the Fed. So up until that point, while the gold standard had technically been ended for most of us in 1933 by Franklin Delano Roosevelt, it wasn't until 1971 that the gold standard really was rendered moot for everyone, including central banks. So when that happened, suddenly the U.S. Federal Reserve and the United States would be paying any and all debts using U.S. dollars. And of course, these are U.S. dollars that the Federal Reserve can print. So what happened at that time was you see a sudden ballooning of debt relative to the actual economy in the United States. And there's a chart in the book which shows basically GDP, which is gross domestic product, which is the annual output, annual economic output of the U.S. And the second line is the total debt securities in the financial system. And what you see in this chart is that starting around 1971, starting in the 70s, these two lines are pretty close together. But after 1971, when they were removed from the gold standard, the trajectory of the debt line goes almost parabolic and just keeps going up and up and up. Meanwhile, GDP continues kind of in a linear fashion growing. And what this was that suddenly the system's flooded with debt because debt's being paid for by dollars, which the Fed can print at any time. So there's no limit to any of this. And what this did was it got us to a point where in the late 90s, the amount of debt relative to the economy was so massive that if ever there was a serious period of debt deflation, which is basically a time in which debt prices are falling, which means they're starting to go insolvent, which means that people are going bankrupt, you're going to have to restructure debt. As soon as that started to happen, the Federal Reserve would panic and flood the system with liquidity. Because the dirty secret for central bankers is that the thing they fear most is debt deflation. Because when debt deflation hits, which is when debt falls in value, which means its yield goes up, it means it becomes more and more expensive to issue debt. And if most governments in the world have been financing their budgets with debt, the minute the debt deflation hits, that's essentially the bond market saying, hold on now, it's going to cost you a lot more if you want to continue financing your budget. So this is always the focal point for the Federal Reserve, which is why starting in the late 90s, the Fed switched to a policy of intentionally creating asset bubbles, because the alternative would be to let the financial system reset by allowing the debt to clear. And nobody's going to go for that because it's, first of all, political and career suicide. And second of all, it's a complete systemic reset. So Greenspan, then Bernanke, and ultimately Yellen all engaged in the same policy, which was let's create asset bubbles. And anytime that the asset bubble bursts and a crisis hits, we'll simply flood the system with more money and create another bubble.
Yeah, this is quite interesting. Also, in light of the cryptocurrency developments, you mentioned the central bank power of printing money, for fiat money, this whole monopoly power. Do you think that governments will give up this monopoly power to private-based cryptocurrencies? This would be something that would not allow them to print money at will, if you would.
No, they won't endorse that in any way. Cryptocurrencies are the result of two things. One is the fact that central banks are basically trashing their currencies by printing so much money. And capital flows to where it's treated well. And if your alternatives are, Swiss francs or euros or dollars, all of which are being printed by hundreds of billions, you're going to seek something else. So I view cryptocurrency as a natural kind of reaction to the system being set up the way it is. It's essentially an individual saying, well, I want to get out of this somehow, and I'm going to create an alternative. The secondary effect is capital flight from China, which is that hundreds of billions of dollars are fleeing China, and they're using Bitcoin and other cryptocurrencies to get the money out. We know that 80% of trading volume of Bitcoin is actually in China, but that's sort of a topic for another time. But no, to answer your question, the Fed will never endorse cryptocurrencies. What the Fed will most likely do is try to create its own. And we know from an interview that the New York Fed president, William Dudley, gave back in November, that the Fed has actually been examining this and looking into creating their own alternative to Bitcoin. And the Fed would love that, because if the Fed could somehow get the system to go completely electronic, meaning physical cash no longer exists, it would allow the regulators to monitor every single transaction that occurs, and it would also remove the systemic risk of cash, because physical cash only represents about 1% of the actual wealth that's in the system. And another dirty secret is that if enough people ever went to the bank and demanded their money in physical cash, the whole system would blow up. The money's just not there. 99% of the so-called wealth is just electrons stored on bank servers, and none of the banks actually have this money on hand, which is why a big goal for central banks is to get rid of physical cash in the next 10 years or so.
Yes, I agree with you fully. And that gets us into your other section on what is to come. So you do talk about that, the war on cash. And also I would say it ties into negative interest rate policy, because, with the abolishing of cash, it would allow central banks to more easily implement monetary policy, especially if it goes into negative interest rates. Would you agree?
Absolutely. So if you look at what I call the period of serial bubbles, which is the late 90s till today, the Fed response to every crisis has been more and more extraordinary. When tech stocks blew up and we had the tech crash, Alan Greenspan kept interest rates down at 1%, and he kept them there for like 3 years more than he should have, which is what created the bubble in housing. Because if the rate of interest held by the Federal Reserve is lower than the growth rate of economic activity, money is essentially free, because you can borrow money at the interest rate, invest in almost anything in the economy, and you're going to pocket the spread. So that was how the Fed dealt with the tech crash. Then the housing crash happens, and the Fed cuts interest rates to actual zero, keeps them there for 7 years, and does something like $3 trillion in quantitative easing, which is basically printing money and then using that new money to buy assets from the banks, which is a kind of backdoor bailout. It's essentially the Fed doing a kind of cash for trash for the Wall Street banks. So if that's what happened last time around, and we now have a bubble in sovereign bonds, and those are the most senior asset class in the financial system, the natural and logical conclusion would be that when this bubble bursts, we're going to have to see even more extreme policies. And the Fed has already hinted at, in research papers and in speeches, what those policies would be. They would most likely be negative interest rates, meaning the rate of interest the Fed is charging on the system is -3 or maybe even -5. We'd also have that combined with nuclear levels of quantitative easing, so quantitative easing of like 100 billion or more per month. And then at the same time, they'd try to ban cash. And the way all of this would work is you implement negative interest rates. Well, that makes it difficult to sit on cash. So you ban cash so that people can't get their money out of the banking system and in a safe. Because if a bank's trying to charge you 3% on your deposit, well, heck, just put your money in a safe. You don't have to pay that interest anymore. So the Fed's going to want to close the loophole that physical cash presents. Then nuclear quantitative easing, the goal there is to just buy as much debt as possible to try and stop the debt bubble from deflating in an attempt to reflate it. And then the final policy will probably be some combination of wealth taxes, bail-ins, and capital grabs. And what basically the way I would describe this is, think of it this way. If the problem is that there's too much debt, your goal is going to be to get as much capital as possible. So any money that's lying around, whether it's in physical cash or it's in, say, a payroll check you haven't cashed for a couple years, you just forgot about it, or perhaps a CD, a certificate deposit that's lying around, or even savings deposits that you have at a bank, governments and regulators are going to want to get their hands on as much of that as possible, because at the end of the day, the issue is there's too much debt. Most of the large entities in this system are financially insolvent as soon as interest rates normalize. And so they're going to try and seize as much capital as they can.
Yeah, exactly. And The NIRP, negative interest rate policy, could also be in light of inflation or rising inflation if you have real interest rates as being negative. So nominal minus interest equals real.
Mhm.
Do you see, what exactly do you see playing out in terms of negative nominal interest rates or just negative real interest rates with rising inflation?
I think we'll see actual negative interest rates, meaning the interest rate is in the negatives, like -3 in nominal terms. If you look over the history of the Federal Reserve, typically when they react to a crisis or a recession, on average they cut interest rates about 5% from their prior peak, which, following that line, if interest rates are at, say, 3% when the next crisis hits, they're going to cut them 5%. That's going to get you to -2. If interest rates are around 1, that gets you down to -4 or so. And this is how it's been every time for the last 70 years. So I do think we'll see nominal interest rates. We had them in Japan. We had them in Europe. Both cases demonstrated that nobody who implements them actually gets kicked out of office, which is the ultimate, fear for politicians and the Federal Reserve, the central banking class. So no one gets kicked out of office for doing it. And for whatever reason, the system goes along with it. The reason the system goes along with it is if your option is, okay, I pay a little bit of money in NIRP and I end up losing that money, but the bond bubble stays intact and the system continues to function, versus I don't pay NIRP, I dump my bonds, the bond bubble blows up and everything goes systemic reset, you're obviously going to choose the first one. So this is why central banks have been allowed to get away with policies that just defy logic. If the alternative is everything blows up, you're going to go along with it no matter what. And we saw this with NIRP in Europe. We saw it with bail-ins, which is when your savings deposits are actually rated by the bank and used to keep the bank afloat. We saw that in Cyprus. They got away with it there. So currently, there's not really any indication that there's going to be enough societal unrest to actually stop central banks from doing this. So obviously, they're going to do it.
And do you see the everything bubble as bursting at some point, or will it be more of a situation where these measures, as you mentioned, the financial repression of NIRP, war on cash, bank bail-ins, wealth taxes, do you see those measures as ongoing within an everything bubble continuing to expand?
Yes, the second option, they're continuing. Well, it's very complicated to answer that, because if you have an everything bubble, you're going to have small asset classes blowing up. The real question is what happens when the sovereign bond markets finally blow up. That's when you get the actual sort of systemic crisis. So if you look at the debt markets as different sectors, for instance, the subprime auto loan sector is currently under a lot of duress. So there's little areas in the economy that are already blowing up here and there. My view currently, and what we've been telling our clients, is that we think central banks are going to have to taper and withdraw liquidity this year because inflation is beginning to threaten the bond bubble. What I mean by that is bonds trade based on inflation. So if inflation is rising, bond yields will rise to match it. If bond yields rise, bond prices fall. And if bond prices fall enough, then you start to have a debt deflationary collapse. And what we're starting to see is that the bond yields on the German, Japanese, and United States government bonds are beginning to all rise. So the bond market, the sovereign bond market, is beginning to react to a fear of inflation. Now, if central banks have a choice, pull liquidity and let stocks drop, or continue with the liquidity, let the inflation genie out of the bottle and blow up bonds, they're going to choose number one. So my current view is that in the near future, like the next 6 months, you're going to see a lot of central banks pulling back, getting more hawkish, and they're going to let stocks correct in some way to try and keep the everything bubble, the bond bubble, intact. Whether or not that works, I don't know, because once inflation starts rising, it's very hard to get it under control. So that's where we are right now, but actually timing the everything bubble bursting and saying on this date it's going to blow up, that is impossible. What you can do is you can look at what's developing in the markets. That's what I do in my financial newsletters, and assess where we are in things. Currently, we're starting to get into dangerous territory, and what matters now is to see how central banks react to it. If they pull back and get hawkish, they probably can get away with keeping the show going a little longer. But if they just keep printing money, particularly the ECB and the Bank of Japan, and funneling it into the financial system by tens of billions of dollars, inflation's really going to become a major problem, and that's going to really crash the bond market. So that's where we are right now.
And what about longer term, how you see that playing out?
Well, longer term, at some point, the whole thing is going to blow up just like it did in '08. Timing exactly how that happens, you're going to have to look for key things. What triggered '08 was the underlying asset class that the bubble was based on, in that case, housing. Those prices peaked and began to drop. So that started to happen with sovereign bonds recently. The question is, does that continue to happen? And then do you start to see the derivatives markets and the credit markets locking up? Because if you look at '08, the crisis, in terms of the progression, you had housing peak in '06. Then you had some of the investment funds that were investing in subprime mortgages, which is the riskiest component of the bubble, blowing up. That was in '07. And then in '08, the derivatives and credit markets locked up, and that's how you got the great financial crisis. So if you use that as a kind of template for where we are now, the underlying asset class, in this case sovereign bonds, has peaked and is beginning to turn. The question is, does it continue to do that, and do we start to see investment funds, bond funds, and then the credit markets blow up? We've yet to see that, and that's the key thing I'm looking for right now. If that starts to happen, that means we're in the late 2007 area of the timing of the next crisis, which would mean the next one would be, say, in the next 12 to 18 months. But again, these are the things we're all looking for. I haven't seen them yet. There's no definitive sign that the crisis is beginning right now. The only definitive thing is we're seeing that bond yields are rising, and this is going to start to concern central bankers very shortly.
Could the sovereign bond debt crisis be catalyzed through Europe? If we look at Europe, what's happening in terms of withdrawal of some of the quantitative easing from 60 billion euro per month to 30 billion euro per month. Could the actual crisis come out of Europe rather than the US or Japan?
It could come out of Europe for sure. It could also come out of China. In terms of Europe, the issue there is that you've got a lot of distinct countries with their own individual central banks, none of which can print the currency anymore. The only bank that can print euros is the European Central Bank, which is overarching all of the European Union. Germany has its own central bank, so does Italy, but they can't go and print euros. And that's what actually led to the crisis with Greece and these other countries. Well, let me back up. What led to the crisis for those countries was they had too much debt relative to tax receipts. The reason why those crises actually accelerated and became systemic in nature was their central bank could not print currency or engage in bailouts directly to try and prop the system up. They had to go to European Union. And if you go to the European Union, then you have issues where countries like Germany and France are saying, well, why are we bailing you out when we don't have a crisis ourselves? So Europe is a kind of weird case of mutually assured destruction. On the one hand, if a country leaves the Eurozone, and not like Britain did, but like an actual country that's located directly in it, like Italy or France, then the whole thing blows up because suddenly the credit markets go, because at that point the credit rating for the European Union is different. You start seeing interest rates rising, and that's what renders these countries insolvent. So Europe's kind of a strange case where they've sort of cobbled this thing along a lot longer actually than I thought they would. I thought they were actually at serious risk of going under in 2012, 2013. But again, it comes back to that original issue, which is if the option is, do I go along with this insane policy and the system is kept afloat, or do I reject it and the system blows up? Everybody in a position of power, whether it's politicians, large-scale financial firms, or central banks, is going to go with number one. But absolutely, if you wanted to look at countries that are at risk of blowing up, Europe would be top of the list, along with Japan and China. The U.S., while its debt situation is also catastrophic, has the benefit of having the reserve currency of the world and a more diverse and liquid economy. So, the way I like to put it is the U.S. is kind of the least dirty shirt in the bunch. But the reality is every single one of them is in serious trouble the minute rates normalize. And when that happens, then it's anyone's guess exactly how it goes down.
And finally, how do investors invest in this environment? How can they protect themselves in what you're saying is likely to happen, just from a generic asset classes point of view?
Sure. So, everyone's risk profile is different. If you're looking for sort of active investment advice and sort of being steered through the financial markets on a week-by-week basis, I write a financial product called Private Wealth Advisory. That's the sort of actively involved, we're buying commodities now, we're selling bonds now kind of thing. That's more for people who are actively in the markets who want to have their capital directed in a way that they're going to continue to profit no matter what happens. If you're someone who's more just concerned, what do I do when the next crisis hits? How do I prepare? I'm not really looking to invest actively. The best bet is probably to invest in actual hard assets, things like gold, real estate, things that you actually can touch with your hand, things that actually, in the case of hard assets, real estate produces some cash flow, so there's benefits there. But really think of it this way. If the whole world is based on paper debt, then actually owning something outright, particularly something that has some sort of financial stability and a less volatile price movement, that's probably going to be one of the safer places to be. Does that mean that if you put all your money in real estate, you're not going to lose anything when the crisis hits? Absolutely not. Everything will get hit. The question is, how do I preserve my capital in a way that it's hit less and I emerge from this situation with as much of my wealth intact? The only real way to go about that would be somewhere in the hard asset classes, gold, precious metals, real estate, businesses that have operating cash flow and stable demand, things that, there's a big reason why Warren Buffett's been loading up on things like Kraft and other businesses that no matter what happens, people will continue to eat cheese or continue to drink beer. He was in Budweiser a while back. And that's sort of the way I'd look at it that way. So it really depends on your risk profile. I can't say, hey, everyone go do X, because everyone has a different risk profile. Everyone has a different interest. But the reality is, if the big picture way of looking at things is, hey, there's too much debt, central banks are going to be forced to devalue their currencies to finance that debt, you're probably going to want your money in something that's of tangible value as opposed to something that's based on that currency, which is going to be devaluing.
Well, that's great insight, Graham, and thank you very much for being on the program show. We'll post a link and information on the book on the website as well. And do you have a website that our listeners can learn more about your work?
Sure. We have two websites. One is Phoenix Capital Research. That's PhoenixCapital research.com. That's our website for our paid products, where if you're looking to be actively involved in the markets, you want someone actually directing you to buy and sell different things and to tell you what symbols to buy and what price to pay, that's where you want to go. If you're looking just to get sort of more familiar with our work, you can do two things. One is you can buy the book, The Everything Bubble, The Endgame for Central Bank Policy. That's on Amazon right now. Or you can go to our free e-letter. That's called Gains, Pains, and Capital. So gainspainscapital.com. That's totally free. I send out a daily briefing on what's happening in the markets and assessing some of the big picture things that are going on in the system. And finally, we're on Twitter. It's Gains Pains Capital, but the Twitter handle is Gains Pains Capit, ending with the T. And you can find us on Twitter, and I'm on there most days commenting on what's happening in the world. So those are a lot of different ways you can get a hold of us.
Great. And also we will interweave some slides that you'll send within the body of the transcript of this podcast on our website as well. That would be great, Graham.
Sure. Based on the conversation, I've got a couple charts in mind that should help illustrate some of the things we talked about.
Great. Thank you very much, Graham, for being on the show. Thank you.
My pleasure, Richard.
The FRA Roundtable Insight Show is for informational and educational purposes only. and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.